program for contemporary European politics and society here. This is an event that's co-sponsored with the EU program of Professor Moravcik and Professor Mounier. And we're very, very pleased to have this afternoon Antonio de Leccia, who's going to speak about EU integration and the euro area crisis. Dr. de Leccia worked in the Spanish government before he went into the EC Commission. He was an advisor, economic advisor to Romano Prodi in the Commission from 1999 to 2004. And since 2009, he's been in Washington in the hot phase of the euro crisis, explaining what Europe is doing about the euro crisis to increasingly nervous Americans. I wonder now whether he's having a kind of reversal of roles, and now that the euro crisis looks slightly calmer, trying to explain American problems to increasingly nervous Europeans. But I'm sure you're going to talk about both aspects, both of the transatlantic aspects of the crisis in the course of your presentation. Thank you so much for coming here.
Thank you. It's my pleasure to be here at Princeton. I was very glad when I was invited by Professor James. It's my first time here at Princeton, but in some way it's familiar to me. One of my uncles was here very long ago, and he spoke often about Princeton, so it has something familiar to me. I'm also glad, as Professor James has said, to be speaking to you today rather than 1 year ago. 1 year ago it would have been maybe more difficult to persuade you about some of the issues that I'm going to talk about. And on that, let me, sorry.
We should just cancel that, I think. Yeah, excellent. You should, yes. Sorry about this.
Okay. Yeah. Perfect. So, what I would like to go through today is I would start briefly with where are we now, and I would underline that the indicators hint that the worst of the crisis is behind, but we are aware that there are many challenges and that there is no room for complacency. Then I would like to go back a little bit to those opinions, particularly here in the US, about the "we told you so." I mean, the crisis was foretold, and the economic and monetary union and the euro will not work. So I will explain how, partly taking into account those misgivings based on academic analysis, but also on political or other opinions we're taking into account, and that, broadly speaking, there were big benefits from the first 10 years of the economic and monetary union. But then we all know that this went wrong, and I would like to spend a few minutes on what went wrong and how. Then the next, of course, the next stage is what are we doing to get our act together, in terms of policies and in terms of back to integration. And I will conclude with some remarks. So where are we now? Again, as I said, compared to the situation or the public opinion or the opinion 6 months ago or 1 year ago or 18 months ago, we can see that those that had predicted the breakup of the euro area or the eurozone are now really having to explain to themselves what happened. And I've quoted a few remarks in the last 18 months by some very well-known economists and commenters about what was going to happen. These apocalyptic scenarios as we all know, didn't materialize. And we can see now, and I will quote Mario Draghi, the President of the European Central Bank, saying that significant progress has been made. This progress is being due to the reforms, fiscal and structural, that are being undertaken in the countries, especially in the distressed countries, but also in other countries that are not now under the magnifying glass of the markets and the opinionators. But it's also been helped or determined by the improvements and the progress that has been made in the governance at the level of the euro area, again, both in terms of fiscal and economic integration, and also indeed due to the bold measures by the European Central Bank. So all that has returned in some way the vicious circle of the confidence loss, gradual loss of confidence that had been taking place during the crisis. This is now being reversed, or starting to be reversed, so that confidence is gathering pace. And the same as there was a negative contagion of confidence across the markets and across the global economy, there may now be a positive contagion that can help recover. So, as I said, confidence in financial markets is growing considerably. Borrowing costs for Spain and Italy are going down, are coming down, especially at the beginning of this year. Deposits are returning to southern European banks, so the capital flight is reversing slowly, but surely. Corporates in Spain and Italy that were also very much affected by the sovereign distress are now being able to go back to the market. And for instance, and the countries that were seized out of markets, particularly those under programs, Ireland particularly, recently issued a 3 billion 4-year bond, and Portugal is preparing for that. At the same time, external imbalances are narrowing. In Spain, exports grew by 20% in the last 2 years, between 2009 and 2011. Unit labor costs have decreased by 20% in Ireland. And what is also important, the convergence is returning because domestic demand in the surplus countries, in Germany particularly, is strengthening. And pay agreements in Germany in 2012 reached almost 5% on average. So the unit labor costs are also converging. At the same time, the news about Greek fiscal deficits are finally on the right side, and sentiment indicators that were released last week by the European Commission show some signs of stabilization. Again, we are aware that there is no room for complacency, that big challenges remain, and the biggest challenges, as we all know, are growth and unemployment. So now back a few years, and what I mean, the foretellers of what was going to happen. And if I go back to using a paper by Lars Jonung in 2009 that reviewed the opinions of US economists between 1986 and 2000, I think 2001 or 2002, and he summarized he entitled his paper, or their paper, as it's a bad idea, it can't happen, it's a bad idea, and it won't last, paraphrasing the opinion of Rudy Dornbusch in 2001 when looking again at the various opinions of US economists. And why, I mean, what were the grounds for these quite negative prospects? First, that the EU was considered to be less suitable, to be a less suitable monetary union than the United States, according to the initial optimal currency area theory. They noted that there was an absence of redistributive mechanisms to cope with asymmetric shocks. Unlike with US federalism, the wages were much stickier than in the US, and labor mobility was indeed much lower than in the US. And they remarked that the monetary policy objectives of the Fed and of the ECB were different. And as importantly, some of the academics underline that yes, as we said on the other side, the economic and monetary union and the euro was a political project, but in their opinion, the political price necessary for EMU would prove to be too high for it to go on. So on top of that, as I said, we took account of quite a few of these remarks and of these assessments, and for instance, some further accompanying integration steps were taken alongside the economic and monetary union. For instance, fiscal integration. So we established, or the EU established, some entry criteria for countries adhering or joining the economic and the euro area. They established rules, particularly fiscal rules, namely a medium-term objective of balance or in surplus for national budgets, a 3% maximum deficit, you know that, a 60% maximum debt, or a significant decline towards that, and then enforcement mechanisms like preventive early warnings and corrective mechanisms with a toolkit that range from just summoning or recommendations all the way through possible sanctions. At the same time, fiscal was not the only area that was brought into more integration. There was some even much looser informal economic integration in other areas. There were the informal economic, mainly fiscal, policy coordination meetings at ministerial level, the Eurogroup. Besides fiscal integration, there was also some structural integration with what was called at the time the Lisbon Agenda, which was a relatively loose system of common assessments leading to the issuance of common guidelines and the peer review of progress made by various member states towards the objectives that were set jointly, and national reform plans that took into account this common assessment and tried to make progress towards solving the inefficiencies and the distortions that were found in each member state. At the same time, there was a big step towards financial integration with harmonization of financial regulation that followed the liberalization of capital markets that had taken place already in 1992. So this gave rise to quite an integrated financial market as regards money markets, for instance, but also lending in many respects. So, and unlike the doomsayers, it did work. It did work to a large extent, and I will be quoting a World Bank report produced last year called the Golden Growth Report that concluded that between 1970 and 2009, so true before the Economic and Monetary Union, but not before integration, poorer economies grew by almost 4% per year. And even not poorer, but even the wealthier ones grew by almost 2% per year. And GDP per capita growth was also significant. In Western Europe was 1.6%. In Eastern Europe it was 4%. That compared to 1.7% in the US, 3.9% in East Asia, and 1.6% in Latin America. Beyond that, there was a surge in trade. There was a surge in jobs, which is not sufficiently well known. There was a surge in productivity and also in exports. More than half of the top 30 countries for doing business were in Europe. in terms of research and innovation. Also, the better countries in Europe did even better than the US and the best in the world. And we created what the World Bank calls a lifestyle superpower in terms of the balance between income and leisure, and between efficiency and equity, which was well known and for a long time was also a reference for other countries. So again, quoting the World Bank report, Europe became a convergence machine. There was a brand Europe, and as I said, it became a lifestyle superpower. So all that is fine, but then what went wrong? And then I would say, to start with, it was a combination of two things. One, that the house was half built, and there we knew that it was half built, that the Economic and Monetary Union was not completed, that we knew that, and still we decided to move in. The house was incomplete, but we moved in. And we knew that for some time it would be uncomfortable. And soon after, and besides that, so the house was half built, but we were also shaken by a perfect storm that was compounded by genuine and idiosyncratic storms, so our own problems, but also by the global financial crisis. So, as I said, the house was half built. Financially, there was, I mentioned that there was an integrated market, or quite an integrated market financially, but supervision was still at national level. True, there were colleges of supervisors for those financial firms that operated across borders, but supervision, so this coordination by supervisors of the countries concerned was not efficient enough. At the same time, there was no common resolution mechanism. In some countries, there was no even a resolution mechanism. And certainly for those banks or those financial institutions that live, as is well known, live international, but in the end die nationally, where it's national treasuries that in the end are called upon to when there are problems. This was not sufficiently well prepared. At the same time, there was no common deposit guarantee mechanism, which means that when, for instance, Ireland at the beginning of the crisis decided to fully insure the deposits for Irish banks, that created significant tensions elsewhere, and the fear that there could be a bank run from non-Irish banks to Irish banks as a consequence. Fiscally, I mentioned that there were a number of rules, but it's more than fair to say that the enforcement of those rules was not as satisfactory as it should have been. At the same time, I mentioned also some integration, some loose integration as regards competitiveness, but it's also fair to say that the surveillance was too loose and that imbalances kept on accumulating. At the same time, I didn't mention, but before the Economic and Monetary Union, and in fact the Monetary Union is partly the consequence or the completion or the add-on to the single market, to the abolition of frontiers and barriers to the flow of people, goods, services, and capital. But the single market is still incomplete, particularly as regards services. Not least, there were indeed common statistical rules, but the enforcement of those rules was poor, and the Greek case is one clearly in point. And finally, all those storms brewing in the, under the surface, an important one was that there were no crisis management mechanisms. In fact, there had been a balance of payments facility in the EU toolkit, but this balance of payment facility remained for non-euro area countries, so for EU countries that were not in the euro area. It remained for non-EU countries, so there was a balance of payments facility for non-member states, neighboring member states that were in balance of payment distress. But it had been considered that the creation of the euro area removed the risk of balance of payments, because the other mechanisms would enable it to converge. So with the Economic and Monetary Union, the euro area countries were removed from the scope of this balance of payment system. So, which means that the crisis came without the appropriate mechanisms to fight balance of payments and crises like the one we contemplate. Having said that, I must also underline that it is not that the problems that occurred during the crisis had not been anticipated. And as I said, some academics on this side of the Atlantic and on our side of the Atlantic had indeed identified those problems. The point was that the political capital needed to put in place or to fill some of those gaps was important, whereas the probability associated with those problems occurring was considered too low. Therefore, spend a lot of political capital for benefits to cope with problems whose likelihood was considered to be too low was deemed not worthwhile, and the attention moved to other problems. And also significantly, the house was unfinished, but soon after the house was soon after we moved into the house with the Economic and Monetary Union, there was also the enlargement of the union to 12 new members. That is 80% more new members were admitted. So the house was too small and it had to grow. So we had to cope with both enlarging the house and finishing the house, and all that, and also not to be neglected that the countries that came were brought into the union much wider disparities. Therefore, the problems were aggravated in some cases. So this is where we were when we had the perfect storm. And as I said, the perfect storm was the combination of a number of storms that were brewing already in the EU, the financial and fiscal, the competitiveness imbalances that were accumulating and not sufficiently tackled, and the incomplete institutional framework. And all that was, and the perfect storm was finally triggered by the global financial crisis and the seizing of markets that meant that countries that had been financing themselves in the international markets, so that could finance their deficits, or the households and corporates that were financing their investments internationally, all of a sudden were seized from the market, and the collapse came. So that was that were the main causes, I would believe. But there are also been other types of problems that have been put forward or reminded, and I would mention here the work, the paper by Fred Bergsten, 5 Myths About the Euro Crisis, that was published in the Washington Post, I think in September last year, that claimed that at least the public opinion considers that this was not all. That on top of that, the Europeans will never get their act together, that Greece will leave the euro, and that will doom the whole construction, that on the one hand, German taxpayers will not pay for the lazy Greeks and others, and that on the other side, the Greeks and others will finally revolt against the diktat of austerity policies by the other countries and by the EU itself, and all that will lead to the world economy tanking because of the interrelations. So that was only 6 months ago. So I would, of course, and you would expect me not to agree with those myths, but I will try to put forward why these myths prove wrong, and why we are now slowly but surely turning around the crisis. So indeed, we are getting our act together slowly, and we are 27 democracies, soon to become 28. And of course, democracies means that we must pay attention to our voters. We must not disengage from our voters. And we also have in the history of EU integration examples where there was this disengagement. For instance, the Maastricht Treaty was turned down when it was put to referendum in 2 countries, and we know that the constitution that was meant to kind of balance the enlargement, so that we could go also broader, we could go broader but also deeper into our own integration. This was also turned down when it was put to vote to the peoples of Ireland and France. So so we need to take account of our citizens and what they think, and democracies are often not as quick in delivering as other systems that are nevertheless much worse in many other respects. So we are getting our act together, and we are acting along the 3 axes, which are financial and fiscal stability. That was paramount, and it was the first axis to be acted upon, but also integration, which was necessary again to address the common challenges, and growth, which is the final objective. So much has already been done in this respect in the last 2 years. Particularly, we reviewed our macro financial and fiscal surveillance in order to cope with some of the gaps and some of the problems that had been identified before and during the crisis. We created these crisis management mechanisms with the assistance packages to Greece first, Ireland, Portugal, and Spain. We continued along the financial regulatory package in order to remove some of the incentives that led to the global financial crisis within the context of the G20. At the same time, the ECB provided extraordinary liquidity in order to counter the seizure of markets. We enshrined in the national legislation some of those enhanced fiscal surveillance instruments that had been developed previously EU-wide. We created the firewall so that the assistance packages were not just ad hoc, but became again part of the EU toolkit. And later last year, the ECB also launched these outright monetary transactions. That is the possibility for the ECB to intervene in the secondary markets so as to counter the seizure in the monetary policy transmission, and to restore the single monetary policy that is part of our system. So at the same time, there were the proposals already in 2011 for a single banking supervision, and there were steps towards that end. And there was a growth compact in order to take into account on the growth axis that indeed structural reforms and filling the gaps in EU governance are important, but what will eventually take us from the crisis is more growth. So this is what has been done, but more is still on the table. For instance, there is still another revision to the fiscal surveillance with enhanced surveillance by making the national budgetary processes more in line and in tune with each other, so that there can be a more comprehensive fiscal policy and fiscal peer review and surveillance, and also to take account of the lessons that we have drawn from the crisis. There was the financial regulatory reform is not yet finished. We hope to have it finished by the end of this year. At the same time, there will be what is called in our jargon the banking union, and proposals have started to be made in this respect, so as to implement the single supervisor. The political agreement was reached end last year by the leaders, by the EU leaders, but more measures will follow that one. At the same time, we also want to bring into place some of the, we want to remove some of the distortions that still exist to the single market, particularly in services. We want to further implement a growth package in the way of some kind of blending of grants and loans, grants by the EU budget and loans by the European Investment Bank, so as to promote large infrastructures that connect the various regions of Europe in terms of broadband, in terms of transportation, energy, and research capabilities. And we are also working in the multi-annual expenditure framework within the EU budget, so as to support innovation and competitiveness. So at the same time, member states will have to continue their own structural reforms within their countries, and there is more to come, which is which is based on what the President of the European Council, Mr. Van Rompuy, together with the President of the Commission and the President of the European Central Bank, Mr. Draghi, and the President of the Eurogroup presented as proposals to the leaders last December, and they agreed that they would come back later this year with more clearer proposals for further steps in integration. This is underpinned by work by the European Commission, and also last November, late in November, the Commission presented a blueprint of further measures that could be considered, or that further measures that are important to be undertaken or to be agreed in the short run. So this is what is in the pipeline, and I think it's not biased to say that the strategy is working. We see that the overall current account in the euro area, which is the continuous line, the dark blue line, is now the result of a convergence in the positions of the surplus countries and the deficit countries. The gap between the surplus countries and the deficit countries had increased until the crisis, and we can see that. But it has broadly converged since then, and it's now at the narrowest point since the crisis. Also, the composition of this current account adjustment was in many countries front-loaded, not so much in others. If we see Ireland, it was very much front-loaded in terms of exports and imports. In the case of Greece, there was an initial reaction as a consequence of the contraction in terms of imports, and very little impact in terms of exports. But this was compensated for later with the result from competitiveness gains in terms of much higher exports. And similarly, we can see that for other countries. As I said, this is held by competitive gains, and if we see the weighted nominal compensation per employee, we see that it is converging, so that the surplus countries are increasing, but and this is not all we saw. As I said, in Germany, it is now decreasing, but for deficit countries, there is now a clear reduction and convergence. So at the same time, or simultaneously, financial market tensions have eased, And it's true. I mean, financial market tensions, particularly in the last few months, have eased, but this has not yet been translated to more flows of financing for the private sector. This, as I said, this is partly due to the improvements being made at the EU level, but also to the fact that distressed countries are making progress, are tackling their own problems, and the consequences are being seen. Ireland, as I said earlier, is now able to reaccess the markets earlier than envisaged only 1 year ago or 18 months ago. Portugal is also recording better than expected export growth, and this is helping to offset the weaker demand coming from the contraction. The same for Greece and for Spain and Italy, which leads us to believe that recovery is not for tomorrow, but it may come gradually from 2013 on, and as I said, gradually help overcome the crisis. So it's also important to note, to counter the many voices hinting at the fact that the populace or the public opinion would not support the measures that are being taken, both for surplus countries and for deficit countries, and that some kind of collapse of one kind of another would finally take place. Either let's say, if we can characterize the Nordics or the Germans would stop financing or would refuse to provide more financing, and the deficit countries would say, well, that's it. We have gone through too much suffering, and we don't see enough in return. So, and let me quote a few results of the latest opinion poll that is regularly carried within the Union with a broad, with a broad sample across all member states, that show that the trust in the European Union certainly has declined through the crisis, but has recently rebounded. And trust in national parliaments and governments has also declined through the crisis. The result now is that the trust in the EU, which is really low, 33%, still exceeds the trust in national government. So it's unfortunately it's a disappointment with the political class, both at national and at EU level. But it's no comfort to say that it's even worse at the national level that it is at the EU level. As I said, it's not for complacency, but it's just a fact. At the same time, support for the Economic and Monetary Union has also declined, but it's still much higher than those that are against the Monetary Union and the Euro. And more importantly, 85% of Europeans consulted believe that they will have to act closer together as a consequence of the crisis, so that the solution to the crisis comes from working together and working particularly at the EU and at the broader level. So some, as I said, this is the latest result I just mentioned. The replies to some of the questions. I will leave the slides with you, so I don't need to go at length on them. So the other one is the evolution of trust in national governments and the European Union. As the blue line is the trust in the European Union. I acknowledge that it peaked at 57 and we are at 33, which is certainly not a satisfactory outcome. But we can see that and it's not a leak, but the confidence in national parliaments and national governments is fares even worse. Again, the support for the euro, it peaked in 67, and it has declined more or less always cents. It's now at 53, but and those against have increased, but there is still a significant gap. So, out of the 5 myths about the euro crisis of Fred Bergsten, I think that I can solidly say that the Europeans are getting their act together, unlike initially thought. That the Greek exit has not occurred and no exit is contemplated. That German and other member states, because it's often Germany is often portrayed as the paymaster of the EU, but their share in payments is important as it is their share in GDP, and the contribution to the EU is based broadly on relative income. Therefore, it's finally the share of Germany is only some 20 or 25%, or within the euro it may reach 30 in some cases. But the bulk of the financing is produced by the other member states, and they continue to contribute because the mechanisms are put in place that try to reconcile solidarity with responsibility, and this explains many of the much of the evolution in the governance reform in the last 2-3 years, where a step towards more solidarity had to be and was matched by a step towards responsibility, and vice versa. And consequently, voters in debtor countries that are making strenuous efforts are still supporting their belonging to the euro area, and are largely skeptical of siren songs. And we can see that in the outcome of the series of elections and votes that have been put in the various countries in the last 2 years. During the electoral campaign, there was a lot of populism and a kind of centrifugal force away from the middle of the spectrum political parties. But when it came to casting the vote, finally the more extremist parties did not take as many votes as had been initially forecast, and it was the parties that were more mainstream, that were more pro-Euro or pro-European in some sense, that finally took the largest results in the voting. So, and as we have seen, that the euro crisis is slowly and we believe surely rebounding, and it has not tanked the world economy, and in time the same that the negative contagion that I mentioned earlier had taken place will lead to a positive contagion, and all the problems that were associated with the EU when the crisis may return, and the EU may contribute or may contribute again to the world economy in terms of growth and stability. So, moreover, and I finish with that, the political will of EU governments and citizens should not be underestimated, and it has been underestimated very often by commentators. EU integration has brought significant benefits to the EU and to the global economy. I mentioned a few. The EU and the integration process was shaken by the perfect storm of brewing imbalances within within Europe, and also from the global economy. The response has been multidimensional, as it had to, because since it was a perfect storm with many dimensions, it had to be fought along the same dimensions. Integration has significantly accelerated at the historic pace. In the last, I must say that the reforms, I've been involved with structural reforms since the early 2000s. And I must say that the progress that we have seen in the last 2 or 2.5 years was our dream in the previous 10 years. So in the last 2 years, in terms of structural reforms, in terms of correction of imbalances, in terms of institutional architecture, we have made the progress that we could only contemplate in decades or more initially. And I think it's also fair to say that if we compare the progress of the EU integration with that of the US integration of the 150 years of the Economic and Monetary Union in the US, we are still going slightly faster than it was in this country. And finally, again, to counter some of the doomsayers, the path and pace of these reforms aim at strike the right balance between solidarity and responsibility, so as to take into account both the concerns and the efforts that all those that are more directly concerned with the crisis and those that are in the fringes of it, so that all are led to work together towards the solution of the crisis and the continuation in integration. Thank you very much for your attention. I look forward to your questions.
Thank you so much. We've got slightly peculiar rules for the question session because this is, as you can see from the back, being videotaped. And so you can only ask a question if you have this in front of you. Who would like to start off with this?
Do I put myself in front of it, or does it come?
I bring it to you. It's just really for this thing, okay. So
thanks very much for the presentation. And as you know, always very favorable to optimistic views about Europe. But I don't think that being optimistic about Europe necessarily means we need to be optimistic about all policies of Europe. So I want to challenge you a little bit on this scenario. I'm wondering what data or analysis you have to convince us that what positive progress we see is not primarily a function of the depressed conditions that have been induced in Southern Europe. So let's concede that Europe's done a pretty good job. Some people might not concede this, but let's concede that they've done a pretty good job on moving toward some kind of budgetary and banking regulation. The real issue is competitiveness and growth, and generating competitiveness and growth. And you yourself point out that Europe is not even into positive territory on some of these issues. Much of the work needs to be done at the local level to achieve this. But the real concern is that, of course, you can get a positive trend going on competitiveness if you induce depressed conditions in the southern countries. And if that's true, and if that's what's happening, then you might very well be able to resolve the crisis in the sense of keeping the euro going. But that might not be a desirable outcome. You might end up in a kind of Japanese scenario of perpetual stagnation, which wouldn't be something we want. So how do we know we're really going in the right direction, and not just seem like we're going in the right direction, but actually it's worse?
No, thank you. The point is absolutely relevant and right. And I would be dishonest if I told you that we have the full answer. That those risks are there. Certainly, we are aware of. We have paid a lot of attention to the Japanese case. But I can also tell you that the latest figures, results that we are getting, show that it's not only contraction that leads to this rebound. So it's not only, I mean, the external imbalances are not only because of a compression of imports. It's also because exports are doing better. And this is partly because much of the, I mean, part of the system even in a context of lack of competitiveness, there were significant pouches of competitive firms that are now doing better. Some of the structural reforms that have been put in place in the last few months or couple of years have started to bear fruit. But we believe that they haven't, that in some way we have seen the dark side of these reforms in many cases. Take the labor market reforms. Labor markets in Spain and in Italy and Portugal, Greece have been made much more flexible. Of course, the initial reaction by many firms and the public sector has been to shed work. So in the short run, we see a negative impact. But when demand picks up, when there is a spark of demand, the conditions will be much better, the economy will be much leaner, much more flexible, so that it can react better. In the last few months, we have seen the global demand really subdued, based on certainly on some negative prospects on this side of the Atlantic, but also in the emerging markets. Now, well, bar problems in this country, and hoping that this is solved in the next few weeks, or at least that some of the basic problems as regards the public sector are clarified and solved in the next few weeks. We are also seeing that the emerging markets demand is now rebounding, or at least it will not decline. So we will see a global demand. We will see more flexibility from our side, and some of the reforms in the banking sector, and also the sounder positions of the public sector in some of these countries mean that, for instance, public sectors or governments at both national and regional government that were in arrears in Spain or in Greece will now be able to pay the debts, and this will be an influx of demand that will contribute to trigger that demand, and therefore to avoid the adjustment being only on the from the contraction. So once more, we don't believe. We know that we don't have all the elements there, but we think that there are sufficient elements that contradict the assessment that it's only marginal adjustment, and that it's mainly temporary adjustment due to the cycle.
So I can come to you in a moment if I may. I wanted to ask one question, if I could ask you to amplify something. In a way, this is an extraordinarily fast-moving crisis, and the focus seems to change repeatedly. There are some things that I think aren't really covered by the Bergsten 5 points that you talked about, and in particular I didn't hear any reference to two countries that seem to me to be now at the center of some of the discussion. One is Cyprus, because the question of Cyprus and the problem of the banks in Cyprus with an enormous amount of non-domestic deposits and really very significant banking crisis challenge the presuppositions on which the banking union is proposed. And the second is the UK discussion. And the UK discussion really raises the question of the relationship of bits of the EU that don't want to be part of the eurozone, whether they're really compatible with the process of growing integration in the eurozone that I think you rightly describe as necessary to the solution of the crisis. And so, from having thought about the deficit countries, it seems to me that in this new phase of the discussion, we have a slightly different focus, and neither Cyprus nor the UK are really covered by the points that Baxton was making.
Yes, well, again, two most relevant points. Let me go relatively quickly on Cyprus. Indeed, the case of Cyprus is now under, in progress of solution. We expect to have some proposal later this month, and possibly an agreement next month. Indeed, Cyprus is a case of an overbloated financial sector, and it's also a case where of some kind of geopolitical importance, with non-EU countries being very much involved, or at least or actors from these countries, depositors from those countries being important in Cyprus banks. So all I can tell you is that this is a problem that is of concern to us. That certainly reforms to the banking sector will have to be effected if, from what we hear from the other member states, the solidarity is again to work. So the couple of solidarity and responsibility will again have to be put in place, and it's not an easy case, but we are very hopeful that a solution can be found. And the case of the UK is indeed also quite paradigmatic. It's now it's well known that many in the UK from the beginning were not necessarily fond of deep integration and deep political integration within Europe. It is, and if you see the evolution of integration, it has been all the time a compromise between the tendency towards deepening and the tendency towards broadening. If I can oversimplify the UK or a widespread opinion in the UK, it would mean that it's fine with the single market, it's fine with promoting competitiveness, but don't touch on our sovereignty. So again, oversimplifying. On the other side, we could find again oversimplifying the Monet and the founding fathers proposing an ever-increasing integration and political closeness. So if you look at the various stages in integration, it's being one of these and matched sooner or later with some measure on the other side. So we had the single market at some point. We had the liberalization of capital movements. The monetary union was considered as the natural complement to the single market in order to avoid the distortions that exchange rates could introduce into the single market. Right after the economic and monetary union and the euro there was the Lisbon agenda, so as to further introducing flexibility into the national economies, so to make the economies more flexible. Again, if one could say, towards the EU positions, and the EU was the UK positions, and the UK was very much involved in the launching and the support to this Lisbon agenda of structural reforms, and that was more or less the compromise. So some rules concerning the fiscal surveillance for the economic and monetary union that applied to the 27 countries, but the enforcement part of those of those rules, and particularly those that led to sanctions, were not applicable to countries outside the euro area. So it was a good compromise. The crisis came, and it has shown that that level of integration was not enough, and that going farther means going deeper, and therefore it is natural that those countries that did not contemplate going deeper, raise questions to themselves and to the others about what's the role. The answer from let's say those for more integration is to say, well, it's fine. From the beginning, we have made further steps, but those that made further steps and that were in some way the avant-garde sometimes left others behind, but those that were left behind had always the opportunity to join those of the avant-garde. So it was an open system. And with more or less time, and those the countries that joined the EU undertake to adopt the euro at some stage, but this stage, at the moment, where both they comply with the rules and they see it fit, and we see that a few countries are not yet in the euro area. So this combination and this compromise between those avant-garde and those that were not has always been has always been there, and there has been not a significant conflict in this respect, and this is what we believe in some way can occur. Now, clearly, those that were not in the avant-garde often were not invited to take the decisions to the table of decisions of the avant-garde, and that was resented by those countries very often. So those countries that did not want to be kind of second tier or second class EU members, and that were not at the table where decisions were made, and this led to tensions already at the creation of the Economic and Monetary Union, and the fact that the Eurogroup only had the representatives of the member states adopting the euro and not the others. So when integration becomes more important and necessary, the question arises again. What happens with those that are not in the EU? So will they be sidelined? And clearly, the more we go towards integration, the more likely it is that they will be sidelined, in spite of the efforts of the European Commission, the European institutions, to reconcile the two. And in the case of the single supervisor, for instance, it's paradigmatic. So the decision was made to confer the powers of supervision to the European Central Bank. Clearly, the UK is not a member of the governing body of the European Central Bank. Therefore, they will be out. But at the same time, the regulators will of all 27 member states sit at the European Banking Authority. That is the forum of regulators. Then the UK legitimately said, well, that's fine, but this means that the regulator of the UK will sit next to the ECB, and the ECB will be representing at least 17 member states, maybe 20, maybe 22, 23, and I will always be outvoted by the ECB. So this, there will be an elephant in the room, and I will not be able to fight its will. So this is why, alongside the proposal for the single supervisor, there was also a proposal that was politically accepted by the leaders in last December, which means that the decisions at the European Banking Authority, so by regulators, will be taken by both a majority of the ins and the majority of the outs. So that it will be a double majority that will be necessary in order to pass the decision. So we try to work out with constructive political engineering, ways to reconcile the will of those that need and want to go further with those that don't want to go further, but still can and should contribute to the contribute and benefit from being in the EU.
Hi, thanks very much for your presentation. I wanted to ask if you could speak a little about the proposed directive on an integrated banking system, and specifically, I'm interested in the idea of why regional resolution is the best resolution mechanism in the EU's view. And I understand that part of that is because they're trying to contain spillover effects, but you have spillover effects across countries all the time in the global financial market. And so, especially given two things. One, that as you said, there have long been laws on the books, but the challenge is often getting those laws enforced when there is a moment of crisis. Why the regional level would necessarily be the best level for regulation and enforcement, particularly given sort of the lack of political will. And then the second part is sort of when you were talking about your house that was half built, this idea that we're moving even more of our resolution mechanisms into the half-built house without necessarily knowing that there's the institutional support behind them. Thinking of the fact that already, even just months after the directive has been issued, people are talking about how would they even support a fiscal backstop. And so I'd be curious to know sort of what the justification is behind regional banking integration at this stage in the game.
Well, the justification is, I'm in some ways surprised at the questions. The question coming from the US, where there is a single, or in many respects, because it's not a single financial system in all respects. If you look at the insurance sector, is not maybe as integrated as it is in the EU, but the advantages of having an integrated financial system, integrated banking system, are clear. They provide for a better allocation of resources. They also provide for it's in some way a proxy, but we saw that it was not a good proxy, but for some time it worked as a proxy for fiscal transfers, because countries or private agents in search of finance could tap on financing from elsewhere in the EU and even abroad. So the rationale for the integrated financial system, also underpinning and promoting the integrated market in goods and services, for us, it's clear. Now, the point is about, your point is, well, in an integrated financial system, do you need integrated regulation and supervision? And the answer for integrated regulation, I think it was also clear before the crisis. So working within a single system with different regulations leads to arbitraging, which really distorts the efficiency in the economy. And this is also, incidentally, a reason why we are so keen in cooperation between the EU and the US authorities as regards the financial reform, because otherwise, be it in the area of derivatives or in the implementation of the Basel rules, if there are divergences, and the divergences are important, these may trigger arbitraging by financial institutions or by actors external to the transatlantic economy. So again, as regulation is concerned, I think it's clear. As regards supervision, you are right that one could conceive of a system whereby supervision could remain national, but with a sufficient degree of cooperation and transparency as regards data, so that supervision can, especially for those institutions, for those banks that were cross-border, is paramount. So to be able for the supervisor, for the main supervisor, the home supervisor, to know what the activity of the bank is elsewhere, and vice versa for the host supervisor of a country in which the bank operates, but is not based, is also important. And this was not sufficient. So theoretically, it would be feasible to have decentralized supervision with full cooperation, but it has proved that it is superior to go towards a single supervision. Again, a single supervision doesn't mean, and this was part of the debate before the actual political decision, doesn't mean that the ECB, so the single supervisor, must oversee each and every bank, regardless of the size, regardless of the systemic nature of the bank concern. So there is a broad arrangement that will have to be implemented in the next few months as to what are the relative responsibilities of the single supervisor, the ECB, and of national supervisors as regards the various kinds of institutions. And this is tricky, but it can be effective. And as I said, it was considered to be superior to the option of decentralized, because that was in place and didn't work sufficiently well.
Thank you very much for your presentation. This morning, Financial Times has reported a significant decline or slowdown of the German economic growth, and I think in your presentation, you said German portion of the package is about 20 to 24%, but still Germany plays a linchpin of the whole rescue package. And given the fact that there will be an election next year, or this year, in fact, there will be certain repercussion of if there is this trend of the German economy growth is going down, would have an impact on this solidarity, which is also a very important key to your presentation, that this euro crisis will I think the solution of the euro crisis is based on. So could you give us a forecast, just the hypothetical, or perhaps a possible scenario of the German economic growth going down?
Yeah, I will not deny, and I don't have a much better, well, we have the European Commission produced its forecasts in last November. I read the down scale of forecast for Germany this year, but let me try to respond from a different angle. Clearly, the low growth in Germany and the less than low, even the recession in the countries in the southern periphery is clearly a consequence of the crisis. So one way of looking at it is saying, yeah, okay, well, yeah, now we have to tighten our belts also in Germany. But and therefore we cannot afford to do as much as you could expect from us. Another way of looking at it is that I think it may lead to a very different conclusion, is the following. There has been the perception in the last few months or even quarters that the many in Germany didn't see the crisis, and that therefore they were relatively complacent. So now the crisis in some ways touching their economies as well, which means that it was not virtual, and that the integration in Europe and the integration of Germany in the EU and more broadly in the global economy means that that Germany must take into account the situation in other EU countries, because to some extent it exports to the other countries. It benefits from many of the elements of the construction and the EU architecture. So it becomes more important for Germany to really contribute to solving the crisis as soon as possible. And that's, I would say, I hope, the way that German politicians will present the point and the situation to the public opinion. And as I said, this may lead to a reaction in what we think humbly is the right direction.
We have pretty strict rules about closing, but we have one last question. So
Just
a brief question and a brief answer.
Yes, just a quick one. I know when we talk about European integration, the Euro crisis, we're always talking about Germany, France, and England. If anything, they're not even part of the Euro. However, I mean the Euro, the monetary system. What I'm worried about is that, or fortunately, what's not being talked about is the other 80% that came into this house that's half built. Like you were saying, there was a storm, it was half built, and now apparently the part of the house that's built is asking for renovation, and the people that are in the other part of the house are saying, is there any policy at all for them to join the Euro? Because, I remember when around 2006, Poland, Hungary, and all of them were slated to join the Euro I think right about now. And I'm pretty sure that has been pushed further back. Now with all these changes, with huge changes as far as supervision is concerned, and like you said earlier, these countries that participate in the Euro have a say in the ECB, and the UK is kind of on the side. However, these people never even had the choice to join the monetary system yet, and what is the policy being implemented, or what is the say of these countries that are basically have no choice, that are just hostage practically by the financial crisis? Is there anything that the European Union is doing about these countries that are really not that much talked about in the press?
Well, now certainly some of these countries have had second thoughts about joining the Euro. I must also say that the crisis has shown us the importance of convergence even before joining. So we are, and I will not mention any country particularly, but had we known the state of the economy, we probably shouldn't have let some in, which means that, okay, we learn from both sides. But I can tell you that the will from many or some of the non-Euro countries to keep the door open for their entry eventually is clear. And particularly, I was mentioning the single supervisor. So in the single supervisor, I mentioned that it's open to other countries. So it's not only for Euro area countries. It's open to others that may wish. And the adequate arrangements so that these countries are represented in the decisions have been made with the creation of a supervisory committee that will, where the non-member countries will sit as well, and that will make the decision, or will kind of bake the decision that will eventually be taken by the ECB governing body. So the arrangements have been made so that these countries have a say in the decisions, and that they can join the mechanisms that pending their adoption of the Euro when it will come, and that in the meantime they are not just silent bypassers. They will sit at the main table where decisions, as I said, will be pre-baked.
Thank you so much.
Most welcome. It was my pleasure. Thank you.